Thanks, Elizabeth. That's fantastic. So this is Jimmy. I am the director of the Master of Engineering in Financial Technology and Master of Engineering in Cybersecurity here at the Engineering School at Duke University. I've been in academia for a little while, but my real history comes in industry. I was in finance for about 25 years and held a number of different types of roles and try to leverage those in a number of different ways, both here while I'm teaching and in a lot of my writing. So I'm always excited to see new sorts of things going on in finance, which is one of the reasons that I'm so captivated by cryptocurrency and the cryptocurrency markets. So I will hand it over to my colleague, Lee Reiners.
Jimmy, I gotta like simplify my slide here because yours is nice and clean. There's too much here, but good morning, everyone. We do these intros every time, and I'm assuming that most of these folks are repeat viewers or offenders, depending on your perspective. But I'll keep it short. So I'm the executive director of the Global Financial Markets Center at Duke Law School. Our center focuses on issues at the intersection of finance, law, and public policy. So that includes FinTech. And I teach a FinTech course at the law school. I'm currently teaching a crypto law course this semester. And I have an online Coursera course, as does Jimmy, called FinTech Law and Policy that Duke students can take for free and get the certificate, and everyone else can audit for free and still get the content that way. But good to be with you this morning, and looking forward to these chats because there's always something going on in crypto. So it's never stale.
It is never stale, that's for sure. And so there are a couple of things that are going on, over just the past week or two that I wanted to kind of get your take on, Lee, and kind of how you were thinking about it. Probably the most prolific and the one that a lot of people here care about and are looking at is the SEC and Coinbase. The Coinbase is obviously launching a new product. They've been pretty prolific in the products that they're offering out to people. And so it's interesting that the SEC has decided to step in at this point. You probably have a better idea of what the tipping point was for them. But I do want to make one point here at the outset. And, in particular with not this product, but products similar to this and some of the stuff going on in DeFi. I'm trying to do some research right now. So if any people have some thoughts about this, let me know. But from what I've been able to gather, and this again is not conclusive at this point, but the vast majority of DeFi type products or things that people are going into are pretty simple yield products. As in, if the US government allowed interest rates to float where they should be, a lot of these people would probably be buying CDs. And because they can't get yield anyplace else, they're looking for a little bit of yield. Now, I think it's coming at outsized risk because you're tying up your collateral. But I mean, it is kind of interesting that yield products are among the most popular. And these are not, going out on the, people don't think they're going out on the risk curve. I think they probably are a little bit further than they think. But it is interesting that these aren't some kind of esoteric things that people are going after or exotics. But I'll give you a minute here, Lee, to let me know what you think about the SEC and Coinbase.
Oh man, just a minute.
Yeah, just a minute.
Yeah, I might take the whole hour here. So I mean, I think you framed it perfectly, Jimmy. As we all know that this is a very depressed interest rate environment, has been for the last 10 years. Yeah. If you have a bank account or a savings account, you know that because you're getting squadoosh on those deposits. To borrow a Sopranos phrase there. So, so it makes sense when something comes along and offers you what appears to be essentially a deposit-like product, but pays you 6% interest. So I totally get why people are attracted to that. Certainly, I'm attracted to that as well. But there's a couple of issues, one of which is it's not a deposit because only banks in this country are allowed to offer deposits. That's by law, and there's very good public policy reasons for that, mostly tracing back to the Great Depression. And those deposits are insured by the Federal Deposit Insurance Corporation, the FDIC, up to $250,000. So there's a degree of assurance and safety associated with our deposits. So these are not obviously FDIC insured. These really look like investments, and that's where the SEC has gotten involved. And we can talk more about the specific legal issues, but just to kind of frame it a little bit here, Coinbase is unique because they're a publicly traded company, right? So they're the only cryptocurrency exchange that is publicly traded. So Gemini, Kraken, and others that you may use are not publicly traded. So they're kind of painting this appearance that they're being picked on, but the reality is that they're unique because of this publicly traded function. And they approached the SEC. They said, "Hey, this is what we want to do." Now, when you approach any regulator and you say, "This is what we want to do," and it's pretty clear that what you want to do is illegal, they're going to tell you that it's illegal. And that is exactly what happened here. Now, these products, these yield products, they exist elsewhere. And Coinbase has made this point. These are out there in the marketplace. People are using them, and people by and large are enjoying them. So why can't we have what everyone else has? And the retort would be, if you're the SEC, it's like, well, because you asked us, and we examined it, and it's illegal. And I would imagine that the SEC eventually will take enforcement actions against companies that are offering these similar type of yield products, but it's a game of whack-a-mole. I mean, to build an enforcement case at the SEC takes a lot of time and a lot of staff resources. And as we've talked about, crypto evolves rapidly. So for every one enforcement case that the SEC can take in the interim, there's probably 10 new, DeFi platforms, yield products that have popped up in the interim. So it's really an unenviable task if you're the SEC, but they're on very clear legal footing here with Coinbase, and just a little bit on Coinbase's tactics here, right? Because this is unique. They published a blog post basically calling out the SEC for not giving them what they want. Then the CEO of Coinbase goes on Twitter and has this long Twitter thread. He calls the SEC's behavior sketchy, this and that. And generally, it's not a good idea for a publicly traded company to pick a public fight with the SEC. And as evidence, just look at Coinbase's share price over the last week. So if I were a shareholder in Coinbase, I would not be pleased at all with the approach that they have taken to this. And I suspect that they might face a shareholder lawsuit as a result of their actions. And so I'll leave it there, Jimmy, and we can, take questions or you can follow up there. But it's not going away. This battle is just, really begun, I think.
I agree with you. I think the battle has just begun. I see it from a couple of different perspectives. One, the fact that people are chasing yield of all things. I mean, it's crazy that this is what where we've come to. But people have taken it, as you said. A lot of people are using yield products. This one, the way it was posed up, would be much easier to use. That's one of the things about DeFi for anybody who's participated is the front ends aren't great. The user interfaces can be daunting, to say the least, for some people. In Coinbase, their user interfaces are pretty good. But at the end of the day, I kind of look at this and say, well, is it that much different than a lot of other things that maybe aren't deposit products, but are deposit products? I mean, sweeps into money market funds. Okay, technically not a deposit product. Is it really? Of course it is. And it's very defined. Now it is a mutual fund, different sort of class, but there are notions of these kinds of things that are out there for sure. And I think this one's is a little bit different because you are while you're certainly locking up collateral. I don't know that it's actually a deposit. The public battle that they had the battle that they had in the public, or they're having in the public, that probably speaks to the maturity but of some of the people there. you're right. You don't pick fights publicly with regulators. It never works out well. But on the other hand, and if I just look at the kind of the product and what they're offering, I'm saying, okay, really, because this isn't a bank, they're not doing things in quite the same way. It is a different kind of relationship that they have. Is it really a deposit product? I don't know.
Yeah. Well, I mean, it's important to point out that the SEC is not saying that you can never do this. Okay, what they're saying is that, hey, this is a security, under the definition of the security in the Securities Act. And so therefore, we have a disclosure-based securities regime here in the US. So you have to register with the SEC, and then you have to disclose certain information to investors so that investors can make informed decisions. And that is the fundamental premise of our securities markets, is that investors get to take the risk. All right. And the SEC has never said, no, this is not a risk you're allowed to take. But companies have to disclose so that it's a level playing field. And this actually helps capital formation, right? As every regulator has said at the SEC, the US has the most deepest liquid capital markets in the world. And a large part of that is because of this securities regime that we have built up since the Great Depression. And it's actually helped capital formation. Right, it's actually helped startup companies gain access to capital markets to expand and grow. So I think we talked about this last time, but I think Chair Gensler and others are taking the long view here, which is if crypto is ever going to really go mainstream, if it's going to attract the average person, okay, who's maybe not so tech savvy, then it's going to have to lean into and embrace some degree of regulation, because people need to take comfort that they're investing in something that is legitimate and the risks that are disclosed to them. So this is in keeping with that broader mission. And so if Coinbase wants to offer this lend product, register it with the SEC and then disclose the risk associated with it. And maybe you looked at this more than I have, Jimmy, but it's not entirely clear to me how this how the yield is generated, right? What Coinbase is doing with it. I'm assuming it's being pooled with other Coinbase users who are opting into to lend. And so this looks like a pooled investment vehicle. And the definition of security is broad. There's a lot of enumerated items such as stocks, notes, bonds, things like that. But then there's this concept of an investment contract. And the Supreme Court in 1946, in a case SEC versus Howey, has defined an investment contract.
Not the Howey decision again.
Yeah, well, this is what's relevant. This is what's at play here in Lend, right? And so Howey is a 4-pronged test, so they call it the Howey test. And this is the test that the SEC and other practicing securities attorneys apply when looking at something that might be an investment contract and therefore a security, which is an investment of money in a common enterprise with an expectation of profit, and those profit are derived from the efforts of others.
Except when it's not, right? Except when you want to call it a private equity investment or a private debt investment, which, by the way, all you people watching here, sorry, you don't get to participate in any of those unless you do it through, by the way, a pooled scheme that a brokerage firm comes up with to give you access to those. But of course, they put another layer of fees in there. And by the way, those don't have to be registered. So if you're in a certain echelon, you get excluded from all of those things. So the SEC, while we do have we have in the past had a very
that is a totally fair critique.
Yeah.
That's a fair critique. I mean, there are exemptions to this disclosure-based regime,
right?
Provided it's offered to high net worth individuals or so-called sophisticated investors. Where do you draw that line? I mean, that is a legitimate public policy debate. But in this case, in the Lend product, I mean, it is offered to anyone who's a Coinbase user, or Coinbase's intent. They haven't actually launched it yet, but their intent was to offer it to anyone who's a Coinbase user. And it's very clear when you apply the Howey test to what they're trying to do, it is an investment contract. And that's what the SEC said. And they said, if you go forward with this, we will bring an enforcement action against you. And then, they reacted frankly, like a child who's, demanding that they get, they have a dessert before dinner every night. And parents say no. And then, the child says, well, you must hate me or something like that. It's like, no, this is just how the law and regulation works here. You don't get special privileges.
This is how the regulation works. Okay, I'm going to shift gears here because you're right, we could spend like hours on that. You know, I don't know if you saw the news this week on the New York Community Bank. So that's New York Community Bank is actually the name of the bank that is doing real-time payment processing for Provenance, which is Provenance is part of Mike Cagney's or the company Mike Cagney founded, Figure Technologies, and they're doing immediate settlement for secondary trading. So Figure also has an ATS. Did you? I probably should have sent you this note beforehand. Did you see the news on this?
No, I haven't, but just curious to hear more.
Okay, so it's pretty cool. This is something that so for those of you who don't know, Mike Cagney is the same person that started SoFi. So he has a little bit of experience. He was a trader back in the day and has a hedge fund, still has a hedge fund, I believe. But he founded SoFi, and a lot of you, especially anybody who was a recent student, knows exactly what SoFi is. They have specialized in refinancing student loans at really, really low rates, and now they're doing other kind of lending and things like that, using all the capital markets. They don't take deposits, so we don't have to worry about the Howey test. But anyway, Mike founded the second company, Figure Technologies, which underneath Figure is a company called Provenance. And Provenance is securitizing mortgages on blockchain. So just like we securitize all mortgages. So for those of you who don't know what that is, when you get a mortgage for a home, those are usually bundled and like in a bond and sold into the capital markets, right? And all kinds of people buy those. Large ones are usually held in bank portfolios, but this is what happens. It's called securitization of mortgages. Well, Mike is doing this, or Provenance is doing this on blockchain. And so the advantage of doing this is he's taken out about 100 basis points in cost. So hugely successful. They're doing billions of dollars in these mortgages, and they've taken a lot of money out of the cost of doing this. Well, as they've grown larger and larger, one of the things they've tried to do is to expand some of the things out there and even expand the ways that they're doing some things. And so one of the cool things that was just announced this past week is they're working with a bank, New York Community Bank, which is shockingly in New York. And they're basically using a blockchain-based settlement process. And so they're conducting real-time secondary trades in digital shares. And this is all being done on Figure's ATS. That's an alternative trading system, and that is registered with the SEC. And it operates on the Provenance blockchain, the same blockchain that's doing the mortgages. And so the bank is now the financial intermediary on this, and they're allowing for basically settlements that take place in real time. So the DTCC has finally gone to next day settlements that should have been done 20 years ago, but there was no real reason to do it. Well, now they've shown that not only can we do this, but we can do it in real time. And so this is really a sea change in the way that securities have been processed. And so just like Mike took a lot of the cost out of mortgage securitization, this is one of those things that we could see a lot of costs taken out of this process that is, it's been ingrained in securities trading for basically forever. When I first started in the business, securities settled in 5 days, then it went to 3, then 2, now 1. Well, this has the opportunity, I think, to do a lot of other things and to do things in a much quicker way. So this is one of the things that I've written about previously. One of the advantages I see of cryptocurrency exchanges is that cryptocurrency exchanges, they have, I think, probably 4 significant advantages over kind of traditional finance. One, they act as the broker, right? You don't need to go hire a broker if you're using Coinbase or Binance US or someplace like that, right? They are an exchange, so you have the exchange function. They take care of your clearing and settlement, and they can be a custodian if you want them to be. And all this happens simultaneously. It's all, it doesn't take days. There aren't multiple parties involved. And because of that, the costs are all, lower, and certainly the time. And when you take time out of any kind of financial transaction, you'll also take risk out of it. And so this gives the opportunity. So a lot of you probably are familiar with Robinhood and what happened, last year when they had, huge inflows. People were, shorting GameStop and going long GameStop and just crazy stuff going on there. And they had to freeze trading on it. Well, the reason they had to freeze trading was because they couldn't post enough collateral to guarantee settlement of these transactions, because, as I said, these take multiple days to settle, or they can take multiple days to settle. Well, now with this simultaneous type of transaction, you've eliminated that. That risk is now gone because things are settling in real time. And so the need to post collateral, to tie up cash for basically no purpose, that's all been ironed out. So this is just the first phase of it. They've just started doing this, but I think it offers some huge advantages in the securities market.
Yeah, and Jimmie, people have been saying this for a while, right? That, blockchain sort of true use case would be in back-end processes, right? In clearing and in settlement. Because as you pointed to, it's a very antiquated system. Why does it take, 2 days, I think, currently for a stock trade, an equities trade to clear, when everything's 24/7 in our digital world. So, I think people have been waiting for something like this for a while, and it just hasn't really taken off at a large scale. And I'd be curious to get your thoughts in terms of, why haven't we seen blockchain be deployed on a more widespread basis here when it comes to some of these back office functions?
Yeah, I think there are two big reasons: legacy systems and legacy thought. I would say those are the two big ones. A lot of the traditional financial services companies, everybody here, a lot of these people here have interned or worked at those kinds of places. They're still coding in COBOL and Fortran. They are literally working on systems that were developed, decades ago. And so I think it's hard to do that. The second thing is they're run by, a lot of old guys who, and they are guys and they are old, who don't have any sort of incentive to change things, right? Life's been really good for them. Why would they want to upset the apple cart? And so it takes somebody, I think, with a new venture to really go into this. Mike has the advantage of being kind of a product of some of those legacy financial services companies, but he's started new ones. And, I'll tell you, he's gone out on a limb on a couple of things, securitizing mortgages this way. That was a huge gamble, and now this partnership that he's done. So I think he's willing to roll the dice where, guys at some of the big financial services firms just aren't willing to do that. The other thing I think is a lot of people are waiting for DTCC to do this. Well, why? What incentive do they have? They have a monopoly on this. Why would they change? It's not that they're not exploring these kinds of things, but they've been exploring them for 5 years and you haven't seen anything happen. To your point, Lee, I think that's the problem is legacy.
Yeah. Well, I certainly think, the moment you start to see an initiative like this, generate economic returns, and people's minds are going to change, right? Because at the end of the day, if there's an opportunity to make money, then people will get in. But there's just a status quo or inertia, if you will, sets in with our current processes for clearing and settlement. This mortgage piece is fascinating because one of the issues going back to the 2008 financial crisis, when you saw these, wave of the defaults and foreclosures, and, people were getting foreclosed on, and no one knew who owned the mortgage note.
Yeah.
And this, and you saw all these practices, like robo signing. So like mortgage servicers were just overwhelmed with the number of people that were defaulting, and so they were just hiring people off the street to sign documents or rubber stamp documents, not even reviewing it, just to try to get through this backlog of foreclosures. And their lawyers were going to the courts representing banks, and they say, okay, well, where's the note? And the lawyers would say, oh, well, we don't know. And so if you could point to this on a blockchain, right, that's visible to everyone, I think this can really, help that process and prevent some of those sort of egregious activities that we saw in the 2008 debacle.
Absolutely. I think you're spot on with that. It adds a layer of transparency that previously just hasn't existed. I mean, there's it's not coincidence that we saw Bitcoin and blockchain emerge during the financial crisis, right? I mean, there's a reason behind this. Hey, there kind of a good question came in, and this kind of rolls back to something that you and I talked about probably, I don't know, a month and a half ago. Somebody asking about Bitcoin as legal tender in El Salvador.
Oh man,
kind of what our thoughts are on that. I know you have an opinion and I have an opinion. So what are your thoughts about that? El Salvador going to using Bitcoin as legal tender?
Well, apparently it's been a rough launch. I know there's been a handful of articles written about that, and of course, that's not going to define the overall success or failure of this project, but has not gone smoothly so far, and that doesn't come as a surprise to me. But yeah, I see someone's point there because of the volatility. I mean, so big picture, right? And I said this repeatedly, is that there are just a lot of impediments to any type of cryptocurrency to becoming a medium exchange, and the biggest is its volatility. As we all know, Bitcoin is finite. There's only going to be 21 million ever in circulation. And any asset with a finite supply is always subject to price volatility. And this is just going to be a feature. This volatility is not going to go away, certainly in Bitcoin. And so if you are a merchant, why would you accept payment in something that could go down by 20% the very next day? And so this is really problematic. And I think the fundamental hurdle that crypto will have to overcome if it's actually going to be used as a medium exchange, and frankly, I don't see how it can ever be overcome. Now, there are stable coins or other ways, right? And maybe we'll talk about stable coins here. So that's the fundamental challenge. Now, legal tender is not very well defined, and it can mean different things in different jurisdictions. Generally speaking, legal tender means that you can use it to pay debts, all public and private, right? El Salvador's law goes well beyond that, and it actually mandates that merchants, so any merchant in El Salvador, has to accept payment in Bitcoin. So if offered, they can't say, no, we don't accept Bitcoin. All right, so this is government coercion. I mean, if this happened in the US, people would lose their minds. Look what's going on with, the so-called vaccine mandates, all right? So this is problematic. And another thing to point out too is in El Salvador, I don't think this is as big a deal as many are making out to be, certainly within the crypto community. Now, other countries follow suit, which is a real potential here. And I think that's why people are watching El Salvador so closely. Then it could be a big deal. But El Salvador in 2001 adopted the US dollar as their official currency. And so they've already forfeited what we call monetary sovereignty, right? The ability to create your own currency, control a monetary policy, right? So it's not as if, this Bitcoin thing is, and the dollar will still be legal tender alongside Bitcoin. So it's not as revolutionary as many people are making it out to be. And, the final point, Jimmy, is, I would encourage people, if they're really interested in this, to dig deep into how this is actually working in practice and the people that are behind this. So Jack Mahler, if I'm getting the name right, at Strike, he's partnered with the El Salvador government. There's this very convoluted process in which Bitcoin is getting into the El Salvador economy. So I guess if you're in the US and you want to send crypto or money to someone in El Salvador, you have to get a Strike wallet. You deposit dollars, they give you Tether, you send the Tether to some recipient or to some official entity in El Salvador, and then that Tether gets converted to dollars for the end user. So I don't really understand how that is an improvement at all over the current state of affairs. But listen, ultimately, time will tell if this works or not. But I'm very skeptical.
Yeah, I'm a little bit in the current environment. I'm a little skeptical too. I do think that and hopefully somebody on here or maybe a student or somebody we'll come up with a decent derivatives market for cryptocurrency. That's really what it takes to stabilize currency is a derivatives market. And no matter what you hear, no matter what you think, central banks don't stabilize currencies. Derivatives markets stabilize currencies at the end of the day. And that's such an important thing. We don't really have a well-functioning derivatives market yet in cryptocurrency space, unfortunately. It's one of those things that we're waiting for, but and I know there are a couple of places people are going to say, oh no, there's this guy who has options. Yeah, there's that guy who has options, but most of those are not terribly liquid. They don't really offer the same kind of opportunity and forwards and things like that we need. And this goes back, I mean, there's a lot of precedent here. I know Lee's heard me say it before, but this goes back quite a ways to when the US came off the gold standard in the 70s. There was a very prolific paper by Milton Friedman. There was actually a couple of papers by Friedman that talked about the need immediately for a derivatives market. Otherwise, you were going to see a volatile US dollar, volatile like this it could have been. And so we did develop very quickly a derivatives market, and it seemed to work because it became the currency of choice around the world for a long time. That may be usurped a little bit, but it's a nice quote from Warren Buffett. I don't take a lot of what he says that seriously. I take it with a grain of salt, especially comments like that.
I don't think he'll be bothered by that.
Yeah, no, I don't think he will either.
Yeah, I mean, well, to Chase's point, I don't think there's anything problematic about currency derivatives. These are well-established and effective hedging instruments, and they get to price discovery, which is critical for the functioning of markets, certainly globalized markets like currencies are. I think when you get into some of the more esoteric derivatives, then specifically the mortgage-backed derivatives and CDOs and synthetics and all that stuff, then it's problematic and they turn into weapons of mass destruction. But on the derivatives piece, Jimmy, there are something I've written about. We do have crypto derivatives. So in 2017, in December, in the midst of Bitcoin's first bull market run, for those of you who remember, Bitcoin started the year at $1,000 and then peaked at around $20,000 in December of 2017. And in December that year, we saw Bitcoin futures contracts come to market. CME and the Chicago Board Options Exchange both launched cash-settled Bitcoin futures, meaning that Bitcoin never was traded or exchanged. There was just a reference price, and then you settled up upon the contract's expiration based upon the current price and the contract price. So those haven't really taken off. I don't know entirely why that is the case. We've seen, now there's physically settled, there's Ether futures. As you said, there are options. And I think there are a variety of theories you could put forth in terms of why they haven't taken off. I want to go back to, I just don't know who the end user is, who has the economic utility here, because, listen, most derivatives markets, right, are just speculators. People trading, oil futures are folks on Wall Street and Patagonia vest, okay? They're not folks with a genuine need, but those folks with a genuine need do exist, right? There is an economic purpose. Now you go back to the origins of futures or derivatives, and it's in agriculture. Farmer plants in the spring, harvests in the fall. They're exposed to price risk in the interim. Futures contracts allow them to hedge that risk. And I've always said, well, who is the farmer equivalent in crypto derivatives, right? Who has the need here? Now, obviously, if it becomes legal tender in other countries, then that question will be solved, right? But for the time being, there just hasn't been a lot of interest. And actually, CBOE canceled their Bitcoin futures contract, cash settled, because there just wasn't interest. So, not to say that there never will be, but thus far, it just hasn't appealed to a lot of folks. But if we have an exchange traded fund, which is the holy grail, then I think that changes things.
That changes things quite a bit, and we are starting to see those pop up in other countries. So one of the things that you and I have talked about, and you've actually written about somewhat prolifically, is the whole idea of should cryptocurrency exist? Is it really an asset? All those things. And one of the things that to me I I put the stake in the ground and says, yeah, this is a for real thing, is when regulators start to get involved in a big way. And so, obviously we're here in the United States. Lee and I are in Durham, North Carolina, and we're subject to that. And our views are probably colored by the fact that we're here in the United States, right? We think about that, but you're starting to see regulators around the world take notice. And it's usually in the form of some sort of restriction or clampdown or something like that. I mean, we see, other countries, right? Some provinces in China have gone, become more conservative than the national government, but we're seeing the same thing happen in other places. To me, people see that as a bad thing. I see it as a good thing. I see it that it's becoming more legitimate. People see a future in this. And it also shows that, wow, the status quo is being challenged. And I think, regulation, despite what, and you and I argue about this a lot, despite what people think, regulation is loved by, by the legacy firms. Legacy everything loves, regulation, whether it's in banking or whether it's in airlines or whether it's in, utilities. Despite what they say, they love regulation because it keeps the barrier to entry so high. And this is the case here. I think we're seeing a lot of regulation come in because all of a sudden, we're talking about a $2 trillion market now. And, if they can't, if they can't beat them and they can't join them, well, damn it, we'll regulate them to death. And we'll keep that barrier to entry really high. So my question is, the regulation that's being used right now for cryptocurrency, this is a very novel asset class. Is it appropriate? I mean, is appropriate what we devised in 1934 around securities? Is that still appropriate for this kind of asset class? I mean, certainly we change technology all the time, and we change phones all the time. We change a lot of things. Is something that was devised basically 100 years ago, is that still appropriate?
Well, it depends. Give you a very lawyerly answer there. So, big picture, I think there does need to be a rethink in terms of cryptocurrency regulation, certainly in the US. Now, part of the US's challenge is that we have this alphabet soup of regulatory agencies, each of which, touches on crypto in some distinct aspect, but only from that agency's statutory mandate. So I've met, the Commodity Futures Trading Commission, right? They oversee commodity derivatives markets in the US. They've said that Bitcoin, Ether, and a lot of other cryptocurrencies are commodities. And in the US, commodity spot markets or cash markets, they're not regulated at the federal level. Now, commodity derivatives markets are regulated, but markets where commodities are just bought and sold are not regulated, except for, fraud and manipulation enforcement. And so then you have the Securities Exchange Commission. Well, when it comes to crypto, when is their jurisdiction implicated? Well, it's when crypto is packaged into some type of investment vehicle, and then ownership interests are sold in that investment vehicle, and that's effectively what an exchange traded fund is. Initial coin offerings, right? That look a lot like initial public offerings, right? The name, they play on the name. A lot of times that's going to be a security, right? Because it meets the Howey test. And then you have, the Office of the Comptroller of the Currency, who oversees national banks in the U.S. and has a large say in how banks get involved in crypto. You have the IRS, who calls cryptocurrency property and treats it. You have to pay capital gains and report your trading gains to the IRS. I mean, I can go on, and then there's there's FinTech in the Treasury Department that oversees anti-money laundering laws. So I don't think anyone would design this system from scratch. Okay, this is not a clear system at all. And certainly, if you're someone who believes in the power of crypto blockchain, right? I mean, you're going to want greater regulatory clarity. And as you said, Jimmie, this is a barrier to entry. Just think if you wanted to start a crypto exchange. Okay, you have to first register with FinCEN, the Financial Crimes Enforcement Network, to make sure that you're not facilitating money laundering. But then you're also going to have to get a state money transmitter's license in each state in the U.S. in which you want to operate it. Okay, well, obviously these are digital businesses; they're going to want to operate nationwide. And so, that's going to cost you a lot of money, certainly in lawyers' fees. So I tell my students, like, there's a future for you in crypto. So this is, I think, this system needs to change. And the question is, how do you change it? Because certainly crypto advocates would say, well, we need to change it to make it more clear and less stringent. And I say, well, it does need to be more clear, but I actually think there's some very significant consumer protection issues associated with crypto. And back to my point about commodity spot markets not being regulated, what that means in practice is that Coinbase, Gemini, the largest cryptocurrency exchanges here in the US are not regulated at the federal level. So nobody would suggest that it's a good idea for the New York Stock Exchange or the NASDAQ to be unregulated. Yet that is exactly the position we find ourselves in when it comes to these cryptocurrency exchanges. And so I think that needs to change, but it's only going to change through legislation. And based upon what I'm hearing coming from Congress, there is not a lot of consensus in terms of what to do here. Listen, people in Congress tend to be older, right? They're not going to necessarily be up to date on the latest technology. There's a learning curve. I think they're still, on that learning curve somewhere. And then once they learn, they have to figure out, what do we do? Is there agreement here? Now, I think, if there were to be some type of high profile hack or incident, where a lot of people lost their money, similar to like a Mt. Gox type of incident here in the US, then that would catalyze congressional action. But absent that, I think we're kind of stuck with the system we have. And this is just in the US. Every other jurisdiction is going through this similar process, right? In terms of understanding the technology, understanding how it fits within their current laws and regulatory regimes, and then figuring out, okay, what do we need to change and to adjust? And so it's all over the place. It's changing quite frequently. You alluded to China, who's essentially, shut down the entire crypto market. But there are other jurisdictions who are leaning into crypto and saying, we want to be, the home to crypto entrepreneurs. And, these tend to be smaller countries like Malta, some of the Caribbean countries as well. And I think there are some real risks to that from a financial stability standpoint. We learn over time that you could have this race to the bottom when it comes to like traditional banking regulation, right? In a global economy, the banking system is only as strong, right, as the kind of the weakest regulatory regime. And so we built this apparatus, the Basel Committee, not to get too far in the weeds here, but there's these international groups, the Bank for International Settlements, the Basel Committee on Banking Supervision, right, designed to bring countries together to establish minimum standards for banking regulation. We're a long ways away from a similar type of thing existing for crypto. And so countries are competing and states are competing in the US. I mean, just look at the approach Wyoming has taken to the approach New York has taken with the BIT license. Couldn't be any more fundamentally different. So this can be a bad thing if you're a crypto entrepreneur, but I think it also provides pockets for innovation to occur where the law, the regulation is gray and you can grow, right? You can grow kind of outside of the gaze of regulators because no one's quite clear in terms of who has authority or jurisdiction or what you're trying to do is illegal or not legal. So it cuts both ways. And my final point, as I said this before, is for people in crypto say, well, we just want regulatory clarity. I say, okay, well, in China it's pretty clear. You can't do any of this. Probably not the clarity you're looking for. What they're probably looking for is something similar to Switzerland, who's sort of clarified that for tokens, they fall under 3 buckets. Either it's a payment token, right? It's a securities token, or it's a utility token. And then each of those comes with a clear set of rules. And I think that's a prudent approach to take if you're someone who's supportive of blockchain and crypto innovation.
Yeah, no, I think that some rules are certainly appropriate. I don't know if it's the legacy rules, and as you mentioned, the legislators, the majority of the legislators that we have in the United States are the definition of legacy thinkers, right? These are people that I don't know what the average age is, but it's got to be like 60 or something. These are old, maybe it's not older than that, I don't know. But these are not people who are up on this. And so I do worry that this is another industry, and we've discussed it before, that it would be really easy to drive this offshore. If you make it uncomfortable enough, we know what happens, right? We've already seen this occur, and it's a heck of a lot easier to keep people than it is to bring them back. We've had a lot of politicians talking about bringing back, everything. And how successful have they been? Well, just look around and you see. We see that here in the Southeast quite a bit because we have a lot of factories that have closed down that were operating 15, 20 years ago that are gone. I can see that happening with this industry. I mean, you don't want to drive people offshore because this is a virtual industry. You don't have to be, and that's that notion of, what a lot of the regulation prior to this has been, very much rooted in the idea that places had a physical location, places had, had to have a physical being, a physical meeting place. Well, these by definition aren't. And so I think it screams that, traditional regulation doesn't really fit here on, on a number of levels.
Yeah, that's right. I mean, I don't take the threat of losing, some of these companies off to, offshore too seriously. I mean, my stance is if you're not willing to follow the rules and regulations that apply to everyone else, then fine, leave. If someone, was wanted to open a factory that paid below minimum wage and, abuse their employees, and they said, well, if you make us follow these rules, we're going to go abroad, that we'd say, fine, go abroad. So, but, that's just my perspective, given, how I feel about crypto in general. But I understand your point. And at the end of the day, these are policy decisions, right? Everything we're talking about are policy decisions that we need our elected representatives to think about and decide on, right? Is, do we want to embrace crypto? Do we want the US to be the home of crypto innovation, like it's been the home of so much other innovation? Or do we think that the risks aren't worth the benefits? Jimmie and I have different opinions on this, right? But ultimately, this is something that, in a representative democracy needs to get hashed out, in Congress, via our elected representatives. So I think no matter which way you feel, you can't say, well, we're beyond politics or politics is a dirty business, because at the end of the day, politics is going to decide the future of this industry here in the US. So, Jimmie, I got some questions for you, actually. Most of the time you're asking me questions, and they're mostly around regulation, which is fine because that's my bread and butter. But there's a couple things going on in crypto that I from a tech and business standpoint, I haven't had a chance to dive into. So one of which is the Ethereum transition to proof of stake. One of the comments that I get, or questions I get a lot from folks is, isn't crypto this disaster for the environment? And my answer is, well, listen, proof of work coins are probably a disaster because, that consensus mechanism requires by design just a lot of energy usage. And so I know Ethereum is trying to transition to proof of stake. So, how is that going? And then just talk about, governance on a blockchain, because it seems like, governance is anathema to what, blockchain is based on. But at the end of the day, a transition like this is going to require some degree of coordination and governance. So how is that possible?
Yeah, there's two things. Great questions. So they are continuing to transition, and I will mention, the guy I mentioned before, Mike Cagney, who's running Figure and Provenance. They actually use a proof of stake type of approach. So it is a much lower resource need there, and we are starting to see more use of what I'll call permission blockchains that typically use much less capacity in that regard. So those are becoming more and more popular, Baseline and things like that. Ethereum is continuing to transition to the proof of stake. There are some people that love it, some people that hate it. At the end of the day, you're right. It does require a consensus. And governance is done through a consensus type mechanism. Now, almost all the big blockchains have a foundation behind them, a nonprofit foundation and things like that. And that is, if there was a central authority, and it's not really a central authority, it's a central, I would say, meeting place more than anything else, because the authority is still held by the community. Right, the community can reject something, and there is no central authority to push it through. So there is this idea that the community is doing this. Now, in the case of Ethereum, it was interesting. For those of you who don't know, proof of stake versus proof of work. Proof of stake means that you have to deposit a certain amount to become a miner, and it's not mining in the same in the same notion, but you have to deposit so much, and that's what lets you in. That's what allows you to be a miner. When they open that up for people to do, everybody wondered, well, are people going to do this? Are people going to buy into this? Actually deposit money, and it was a fair amount of money that you had to deposit to do this, and they were overwhelmed. It was literally, over $1 billion flowed into it very quickly. So to answer the question really quickly, will people do this? Yes, they will. They will stake money to become miners in this business. And so I think the community has voted by the sheer volume of people that have agreed to do this. It is very expensive to do, so everybody can't do this. There is a cost involved in it, and that is somewhat exclusionary, and I don't like that. Some of the other blockchains require much less of a deposit, but in the case of Ethereum, this was an ongoing entity, and so they did have some different kinds of constraints in that regard.
Yeah, no, thank you for that. And Kevin in the chat pointed out that it takes 32 ETH to be a proof of stake validator, which is about $100,000. So, as you said, it's not cheap to be a validator on the Ether proof of stake blockchain.
Yeah, so, I think when that first came out, it was less than 30,000 to do that.
So Jimmie, my next question is around an issue I haven't had time to dive into. I want to, but it's popped up on my radar here, which is Solana. I recognize that Solana is a new type of blockchain. It's supposed to process transactions at a faster rate, which is one of the challenges with Bitcoin. There's only a new block every 10 minutes. Which is much slower than the Visa and MasterCard network. So talk about Solana. Is it something that we should be following or getting excited about, or is this just kind of another coin amongst many other coins?
I think there is a little bit of a difference. Solana has been kind of floated out there as the Ethereum killer and things like that. And I think the thing about blockchain as a whole, that we have to keep in mind is this is a really new technology. I mean, in the big scheme of things, this is a decade old. That in itself is, something to kind of take note of. And because it's such a new technology, we're constantly seeing changes take place. So Solana does operate at a much higher speed. It allows for more transactions. And as you rightly point out, I mean, Bitcoin is super slow. And I tell people, even though I'm a huge blockchain proponent and I'm a believer in cryptocurrencies, the very first thing I tell my class when I'm teaching, in probably the first 10 minutes is blockchain is not a solution to all the world's problems. It is not the solution to most of the world's problems. Anything that is time intensive is, that is speed intensive. As I said, I started off as a trader, doing a lot of algorithmic trading. Think high frequency trading. This will never replace high frequency trading networks. The ones that are built out there, at least not anytime in the near future. Solana promises to increase the ability to process transactions. I think that to me, when we're thinking about transactions and maybe Bitcoin or blockchain or cryptocurrencies, maybe they never become in the notion that we think of them as transactional, point of sale type transactions. So like you would use a credit card or debit card for. Maybe it doesn't happen in the same way. Maybe it really is a credit card or a debit card based on a cryptocurrency, not the cryptocurrency itself. So there are, I think there are some different changes, but Solana is certainly adding a different a different flavor to things. I think Visa and MasterCard process, and somebody's going to correct me here, about 8,000, or they can process about 8 or 10,000 transactions a second, something like that. Solana, is that they're trying to post themselves up as maybe not going that far, but being much more prolific in that space and being able to do more in that area, in particular around those kinds of things. So I don't think that there's any reason to post it up as, you know, as the Ethereum killer, maybe as an alternative for that. There's also a lot of hype around the NFTs that have been floated. I don't like to hype NFTs for a couple of reasons, and so I'll kind of stay away from that for a little bit. But the other thing, and I was going to say that somebody pointed out here, I can't see who it is, Kaven pointed out here, is cost. Ethereum has any transaction that uses Ethereum has gotten prohibitively cost intensive. The Ethereum network is getting rather expensive to do business on. That's one of the things always comes up in class. You mean it costs something to put transactions on blockchains? It's like, there is no free lunch. If you don't know, you know, what you're paying for something, you are the something. Trust me, nobody does anything for free. So if you don't know what the cost is, then you better be looking really closely, because you're probably paying for it in a way that you don't want. But Solana promises to be much less expensive than Ethereum. And at this point in time, with people doing a lot of things on Ethereum, in particular, a lot of the DeFi transactions, it you know, cost is starting to factor in.
Yep. The gas
fee. So I know we've run an hour here, which is just like shocking. You and I could do this for a lot longer, but we probably shouldn't, because people have to go back to work, and I know a lot of people will be watching this on the recording. As always, it's fantastic. Love the comments. It's fun to see you all. I mean, obviously there are a lot of people here with a lot of thoughts and comments, things like that around this. I really appreciate everybody showing up here. I appreciate the people that are watching this on the recording. Lee, it's always fun to do this with you, and we will be back in a couple of weeks. We'll, you know, post it, and we'll have it out there on Twitter and LinkedIn and all that kind of fun stuff. And if you're here at Duke, you'll see it on the calendars, the school calendars, which is always great. But there is, you know, I think this is something that every 2 weeks, every 3 weeks, we have like plenty to talk about, because it's happening, it's unfolding so fast.
Yeah,
so
we didn't even talk about Walmart and Litecoin.
I know. You know, I kept thinking about that,
Yeah,
but it's like, no, probably not. That's funny. For those of you who don't know, go look at the story. It's the ultimate in fake news. Martin Litecoin. But it's great to see you all. Thanks for participating, and look forward to seeing you next time.
Yeah, thanks everyone. Take care.
Have
Thanks,
a good afternoon.
You too. Take care.